The focus today is going to be based on Learning Unit 3 and Learning Unit 4. Right, so the Learning Unit 3 is the gross income, and the Learning Unit 4 is basically the general deductions formula. And after each and every learning unit, this is what we're going to do. We're going to integrate the theory along with the practice, meaning that I'll cover the theory part, and then at the end of each learning unit, then I will do a question with you. Okay. And guys, I'm going to ask you, please do talk. Please do talk. I am not going to talk alone in this class. Okay. All right, in the gross income here, it says that the income that has been received is usually included in the gross income, which is actually subjected to your taxation. Right, that will depend on what type or which kind of an income are actually going to be received. However, the Act makes a provision for certain types of incomes to be exempted, meaning that under the incomes, there are those that they are not going to be subjected to taxation. You just have to include them as part of your income, and then you create a line called exemption, meaning that you exempt that. So that means if they do not qualify to be part of your gross income, they have to be exempted. Okay, and then after that income has been included in the gross income, certain amounts may be deducted from the gross income as they do not subject it to taxation. That's basically your income, your exempt income. But then today we're going to be focusing on the gross income along with your exempt incomes. My apologies. Just a moment. My PC is just a bit slow. Okay, good. All right, let's have a look at the definition in terms of your gross income in accordance with your Section Act of the Income, Section 1 of the Income Tax Act, rather. So it says that in relation to any year or period of assessment, it means that in case of any resident, the total amount in cash or otherwise received by or accrued to in favor of such resident. Then point I says that in case of any person that a resident or the total amount in cash or otherwise received by or accrued to in or in favor of such person from a source within the Republic. During such a period of assessment, remember guys that the period of assessment we spoke about, that is 12 months period. It's like in accounting we call that the year ended. So in tax is used as the period of assessment, which exclude the receipts or the accrual of a capital nature that will be discussed later as we go on with our studies. All right, so it further says that the definition of a gross income differ from South African residents to and for non-residents. It depends on where are you getting your income as a taxpayer. So if you are getting an income in South Africa, but you are based somewhere out of the country, you are actually going to be taxed. But that will depend on how long have you been in the country, but particularly you will be taxed. But all income based in South Africa as taxpayers or businesses, they are eventually going to be taxed should they meet the requirements or should they qualify. Right, and then we're going to look at the requirements that must be present in the definition of a gross income, which are as follows. You must be a resident and you need to receive the amount in cash or otherwise for the year or the period of assessment, right, which is received or accrued to, excluding the receipts or the accruals of the capital nature. And all of the above requirements must be present before the income can be classified as a gross income, meaning that in the above requirements that I've just mentioned, now should one be missed or one to be missed, it means that it doesn't classify or meet the definition of a gross income. Okay. Let's see our 3.3. Now going to define what the resident is in terms of the Income Act. It says that the resident is any natural person who is ordinarily resident in the Republic, but not as any time during the relevant year of assessment, ordinarily resident in the Republic. If that person was physically present in the Republic for 266 days, or for a period exceeding, in 266 days is an income tax for the period exceeding 91 days in aggregate during the relevant year of assessment. meaning that you have to be presently in the country, physically present in the Republic for a period of 91 days or in greater during the relevant year of assessment, as well as for the period exceeding 91 days in aggregate during each of the 5 years of assessment preceding such year of assessment. And for B says that for a period exceeding 915 days in aggregate during the 5 years period, 5 years preceding years of assessment, in which case that person will be a resident with effect from the first day of the relevant year of assessment. So first we look at 91 days in each year, and it must be total to 915 in 5 years period. Right, and a day shall include a part of a day, meaning that if you are here half day, let's say in the morning up until maybe 12 o'clock, then obviously you're going to be regarded as a resident. But that shall not include any day that a person is in transit through the Republic between two places outside the Republic, and that person does not formally enter the Republic through the port of entry as contemplated in Section 9.1 of the Immigration Act of 2002. Okay, so this is one of the summary that you have to take highly in consideration. The reason behind that is because you can get that question as part of your multiple choice. Right, so it's important to understand what the definition of resident entails so that you will be able to answer the multiple choice question based on the residence. So there's a high possibility that you might find it in your assignment. Right, it further says that where a person who is a resident in terms of this subparagraph is physically present, is physically out of the Republic for a continuous period of at least 330 full days immediately after the day on which such person ceases to be physically present in the Republic. Such person shall be deemed not have been a resident from the day on which such person so ceased to be physically present in the country. I think that's actually in 5 years period. So it is quite clear from the definition that a resident that a person can be classified as a South African resident is either because he or she is ordinarily a resident in the South African or the Republic, or he or she meet the physical presence requirement, ordinarily resident. So an individual will be considered to be an ordinarily resident in South Africa. And if South Africa is the country to which individual will naturally and as a matter of course return his or wanderings. So it could further be described as that individual usually, let me just pull it out. But it could be described as that individual usual or principal resident or his or her real home if the individual is not ordinarily resident in the country, he or she may still meet the requirements of the physical presence test and will be deemed to be a resident for the tax purposes. So ordinarily resident refers to a person normally lives where the person lives with a degree of permanence and where he or she normally resides apart from the temporary or occasional absence. In terms of the case law that has been defined this term, but this measures, you do not have to know the case law. We are looking up to the meaning of the word ordinarily in your dictionary. So this is what happens. You realize that South Africa is actually a mixed economy where we've got a lot of people that are coming into the country for different reasons. It may be for work purposes, or it may be that they are looking for greener pastures. So immediately when these people, they actually enter the ports in South Africa, meaning that they cross the border, they would, in terms of the physical present test, or in terms of the number of days that they would be in the country, they would be regarded as ordinarily resident of the country, meaning that whatever the income that they generate or that they make, they would simply qualify for a tax. Right, let's look at what the physical presence test says. It says that when we meet the requirements of the physical present test, that individual must be physically present in the country for a period exceeding 91 days. I think we spoke about that. 91 days in total during the year of assessment under consideration, was 12 months period. or 91 days in total during each of the 5 years of assessment preceding the year of assessment under consideration, and 915 days. My apologies for that. Or 915 days in total during those 5 years preceding the years of assessment. An individual who fails to meet any one of these 3 requirements will not certify the issue of the physical presence test. We add to that by saying that any individuals who meet the physical presence test but is outside South Africa for a continuous period of at least 330 days will not be regarded as a resident from the day on which the individual ceases to be a physical present. If the individual is either ordinarily known, meet the requirements of the physical present test, that individual will be regarded as a non-resident for tax purposes. Okay. So meaning that if you are out of the Republic in a number of days that reach 380 and full days, obviously there's going to be conditions in terms of non-meeting the requirements of the physical present test. So you must know that the requirements of the physical present test and be able to apply them in a practical situations. So in this case, you would be given a scenario where you have to determine whether the person is actually meeting the requirements in terms of the physical presence test. Otherwise, as a case study, if a person does not meet the first requirement in terms of the physical present test, you do not need to go into the next requirement. Okay. So here's how it goes. You'll be given some kind of a scenario where you have to determine whether the person qualifies to meet the requirements in terms of the physical present test, and then you have to analyze that kind of a scenario, and you will tell us as to whether the person does or does not based on the facts that are given on the scenario. You must also know that the 3 requirements of the physical present test and be able to apply them. Okay, I think I've covered that part. Right, we're now summarizing the requirements for the gross income. And the first requirement for the gross income definition, which is the resident, I think we have covered that up there. It says that the year or the period of assessments of taxable income is calculated for 12 months. As I've said, that 12 months is actually regarded as the year of assessment in tax. In the case of a salaried person, the year of assessment starts from the 1st of March, ends on the 28th or the 29th of February. So they're trying to differentiate that in the individuals versus the businesses or the entities or the companies. So when you do your financial statements for a company, you can pick up any date or any month, right? But when it comes to tax specifically, it starts from the 1st of March up until the 28th or the 29th of each and every year. And then after that onwards, we get what's called the IRP5. It has been covered from the previous learning unit. We get IRP5 from different employers, and then obviously you're going to submit that towards your SARS and from whatever the requirement documents that are applicable in terms of your your submissions in terms of the returns. So this is also called the year of assessment or a tax year. So that's actually opposed to accounting where we call it the financial year. And in the Treasury Department, it's actually they call it the fiscal year. So this is how it works. The Treasury Department, they are actually the ruler, or they rule what's called the implementations of your tax policies or the rates. And the appointed SARS who are actually administering that. So in terms of when the rates are actually going up, or certain income tax rates are actually going up or they're going down, that is the duty or the responsibility of the National Treasury Department. So SARS has they just have to abide by what the National Treasury Department is, but they do work hand in hand, or they work all together. So it further says that is the total amount that are actually received in cash or otherwise. There must be an amount before it comes from the gross income, cash in means of money. Otherwise, it means that, or instead of the money, an asset is given to an income. All right, if the asset is actually given to an income, what we do is we monetize that. We actually have to determine how much is the market value towards that asset, because it's not something that it's more like cash where you can just count it and say, okay, my income is about 300,000, right? But if your asset is let's say it's a car or it's a property or it's whatever. What we basically do is we attach what's called the market value towards that specific asset, and then we come along with a figure, and then that's where we can determine how the tax is going to be acted on going forward. This means that it includes the value of the money from the property that the taxpayer earns, and it must have a ascertainable money value. An example is a person who buys a car. I gave you that example. Trades his or her old car in the past of the selling price of the new car, and the car dealer will actually include the value of the trade in or car as part of the gross income of the sale of that car. So this is how it works in accounting. When you do what's called the notes in terms of the property, plant, and equipment, what happened is obviously there's going to be a movement in terms of your assets, right? So you're going to determine how much will be the cost and how much is the accumulated depreciation, and then you get to the carrying value. When we deal with a certain financial period, we look at how much is the carrying value when we close up that kind of an asset in that specific year. So here's what happens in tax. Instead of calculating what's called the depreciation, we call it the wear and tear. All right. So basically, we don't have the depreciation, but terminology for the depreciation is substituted by the word wear and tear. Right. So, and that would basically give us how much will be the value of that asset in the tax year. All right. So, however, whatever is actually received must have a monetary value. That's basically when you attach the monetary value to that kind of a specific asset. It has to be received by, accrued to, or received by again, and the amount is actually received, which must be the amount must actually be received, which must be received to the taxpayer's own benefit, or tax language. Own benefit accrued to, and the amount that the taxpayer become entitled to, even though it has not yet been received, which leads us to another important concept, that a taxpayer must be unconditionally entitled to that amount. So the amount has to be received, or it must be accrued or due to your taxpayer or to the taxpayer. But going down, this means that there must not be any conditions attached to the amount. I'm not sure what could be the conditions attached to the amount. Maybe if they say the condition might be the amount comes to you, but it will be transferred to somebody else on a certain conditions. All right, and that would actually include the receipts or the accrual of a capital nature. The capital nature of an income is determined in using two broad types of guidelines: subjective tests. So there's an objective test and objective test. So in terms of the first test, the subjective tests refer to the intention of the taxpayer. What are the intentions of the taxpayer? And the intention of the taxpayer is based or is measured by looking at his or her actions and the reasons, as well as the fact of actually that case. So when we deal with the subjective test, we look at the intention of what are the intentions of the taxpayer. Objective test can be used when the intentions of the taxpayer is not clear, or if SARS and the taxpayer differ regarding the nature of an income. So we're going to look at two entities here, or two people. So the intention of the taxpayer is actually not as pure as it's expected, and SARS and the taxpayer will actually just merge to discuss the nature of that income. And the objective factor that can play a role in determining the capital nature of an income could include the period for which the asset was held, or whether the taxpayer was involved in a similar transactions before. We're going to go further and look at the specific inclusions in regards to the gross income. So the definition also includes a list of specific amounts that must always be included in the gross income, no matter what the nature of the income is. In these modules, you do not have to know the complete list of those special inclusions. So that's just for your own ratings, actually. I don't think it will be part of the test or the assessment. However, you must take note that the dividends, fringe benefits, and the amount for the services rendered are three of the specific inclusions in the gross income. So dividends, we're going to deal with it. We partly dealt with it on Learning Unit 1 and Learning Unit 2. So now we're going to finalize it on learning unit 3. And fringe benefit has its own independent learning unit. We will deal with that, but it is part of your gross income. So in a nutshell, the fringe benefit is, I gave an example in regards to the medical aid. Some of the employees, they found out that the employers are actually paying a certain portion towards the medical aid companies, and then you pay a certain portion in regards to that. Same applies to your pension, right? Or your traveling allowance. So whatever the portion that is actually paid by your employer, and you pay a certain portion, we're going to regard that concept in tax as fringe benefits. Right, and dividends, obviously, that will include the local along with your foreign dividends in there. Obviously, there's going to be a different treatment as to how is that going to be. But in a nutshell, that forms part of your gross income. Right, pay attention here where it says that all dividends received by a taxpayer are included in the gross income. I think I mentioned that in my reading. But fringe benefit usually refer to a non-cash benefit granted to an employee by the employers, but do not constitute a cash payment. Okay, so it's going to be part, or it's going to be visibly seen as part of your income. However, it will be contributed to somewhere else. Right, and the fringe benefit will be included in your at a specific inclusion in your gross income. We'll further look at a fringe benefit in learning unit 1, as I've mentioned that it is actually an independent learning unit. Right, I gave an example in regards to the medical aid contribution paid by the employer. It says that the total contribution paid by the employer to the taxpayer's medical aid on behalf of the taxpayer constitutes a fringe benefit. So it's not only or particularly the medical aid. There's a whole lot of list when it comes to the fringe benefit. But let's wait for learning unit 6 to cross that bridge. Okay, the amount of the contribution or the payment by the employer directly or indirectly to the medical scheme for the benefit of the employee. Okay, let me just go down. The amount of the contributions or payment by the employer directly or indirectly to a medical scheme for the benefit to the employee, dependents of such employee for any period, will be included in the gross income of the employee. That has been explained. And the amount of the contribution paid by the employer on behalf of the employee who's 65 years of age or older and is still in the employ of such an employer will be a taxable fringe benefit that will be included in the employee's gross income. So the reason why they bring you the age factor here is because we've got a standard rule in terms of the retirement age in the country. However, we cannot deny that some companies, they need what's called special skills, meaning that even if you reach the age of 60, 65 or over 65, it's possible that your original employer or your former employer, they can reappoint you again on what's called special skills, meaning that nobody, or they cannot actually find somebody who can be competitive for that position. So it's part of the benefits towards the firm and you as an employee. Right, I've seen it happening many times at the University of South Africa, where you've got a lecturer who's actually outstanding at what they do. This qualitative gift within themselves, and they get to be reemployed after their retirement. So what they would do is they're not going to employ you permanently, but they would give you a contract as and when they would need you. So, however, where an employee has retired from the employer of such employer, irrespective of the age of the employee, and the employer continues to pay contributions on their behalf of the retired employee, the fringe benefit will be non-taxable. Basically, what they say here is what I have explained just now in a short while, to say that if they choose to pay that medical aid on your behalf, obviously that will depend on the part or the conditions of your job. So, but it will be non-taxable if you are a retired afforder over the age of 65. For the amounts, on the amounts for the service rendered, all the amounts received for the services rendered, whether they are capital or revenue in nature, they will be included in your gross income. Okay, let's see what it further says. Married in community of property with the income received to a taxpayer received or accrued to a taxpayer other than that from the carrying on a trade, but including investment income and capital gains transactions, is deemed to accrue to a spouse in equal portions. But I've got a question for you. And my question says that, why do you think the marriage types it's important when it comes to anything else but specifically for tax? Why do you think there's an in community or the out of community of property or an antenatal? Why do you think that could be a factor? All right. The reason why the medical aid is, the type of marriage plays a major role in terms of the tax is because it's all about the distribution should anything happens. So you know that if you are in community of property, meaning that your spouse or your partner would be involved in terms of the distribution. Okay, so if it is actually in community of property, so but if it's actually out of the community of property, then it's actually a one-man show. So you go your way, I go my way, and distribution will just be like that based on who owns the assets or the incomes. So that's actually in a nutshell with regards to that. Right, let's go back. So the merit in community of property, the merit in community of property for the income received by or accrued to a taxpayer and those carrying on trade, those from carrying on any trade, but including investment income and capital gains transactions, is deemed to accrue to the spouses in equal portions. All right, the capital gains tax, it's actually an independent lending unit. I think it's the last one, 7, lending unit 7, if I'm not mistaken. And then we're going to deal with that one specifically. All right, however, if there's a transaction that involves the capital gains there, unfortunately, we just have to add it. Right, we just have to see as to how much are the gains or the losses, and then we add it, or they form part of their income tax framework structure. Right, and this includes the rental from the letting of fixed properties, assets that forms part of the communal estates. Right, and the investment income, that includes your interest, which contains the local and the foreign interest received, and the dividends, which are also the local and the foreign dividends. The above means that where taxpayer is married in community of property, all the investment income, or the CGT, which is the capital gains, and rentals from the letting of fixed property, if it forms part of the communal estates, need to be apportioned between the spouses in equal amounts. 50%. We all know that, or we all know the compliance in regards to the share when it comes to the in community of property marriage. Therefore, only 50% of the income received as described below will be included in the gross income of the taxpayer. Right, so meaning that when you submit your tax returns, only the 50% of your portion will actually be included in there. Obviously, that will be determined by the type of the merit that you are in. But exempt income, I've told you that there are incomes that are going to be included in your gross income. However, sometimes they don't even meet the definition to be taxed. And those kind of incomes, they should be exempted. Like I said, what you're going to do is in terms of the framework, you're going to have what's called the gross income. And then after that, you include all of those incomes in there. And the incomes they do qualify to be exempted, you show them. Right. South African interest paid to South African residents, interest received by the South African resident is included as a special case. Same applies to your dividends as well, or your investments income. Section 10(1)(I) of the income, by the way, you guys are actually not allowed to mention, it's not compulsory, you're not compelled to actually stipulate sections. Section 10(1)(I) of the Income Tax Act provide an exemption for the interest earned from South Africa, sourced by the natural person per annum, which it lead up to an amount of, the person younger than 65 is 23,800, that's the limit. And the person who is 65 years and older, the limitation is 34,500. Bear that in mind. Bear that in mind. Every time when you do your assignment, make sure that you write them somewhere bold where you can see, so that they will be able to help you. Right, this exemption does not apply to interest received from a tax-free investment. I know we are aware of what's the tax-free investment, meaning that those are the investments that are actually not subjected to tax. But let's have a look at the dividends. Dividends received from the local South African company are fully exempt. So what you do is, if you've got a dividends in South Africa, you just put them there as part of your incomes, and then you're going to exempt them when you do the second line item under your taxable. Foreign dividends, meaning any amount that is paid or payable by a foreign company in respect of a share in that foreign company, where that amount is treated as a dividend, or similarly payment by the foreign company for the purpose of the laws in relating to that. So number one says that the tax on income on companies of the country in which that foreign company has its place of effective management. And then B, we're looking at the companies of the country in which that foreign company is incorporated, formed, or established, where the company in which that foreign company has its place of effective. The management does not have any applicable law related to that tax of income. So, but here's how it goes. We know that in South Africa, we've got so many firms that are actually not belonging to the South Africa. The headquarters are actually not here. We've got a lot of international companies that are employing South African people. All right, so those are going to be regarded as foreign companies, but they are actually placed in South Africa. Right, so there are so plenty of them, be it retails, be corporate firms, excluding, I think, the governments, if I'm not mistaken. All right, a foreign dividend is included in a taxpayer's gross income but may qualify for full or partial exemptions from the normal tax under the Section 10B. Full exemption will only apply if the following scenarios are actually met. Foreign dividends received from a company listed JSE, the JSE Limited, that's your Johannesburg Securities or Stock Exchange. And then again, the foreign dividends received from a foreign company in which the individual hold at least 10% of the total equity shares. And voting partial exemption. All foreign dividends that do not qualify for the full exemption as described above will qualify for a partial exemption. So the partial exemption, it means that not fully 100%. Obviously, there's a certain portion that you're going to actually adjust on that one. For further in terms of the dividends, and see on how this partial exemption is described as. So the partial exemption is calculated as 24 over 45 of the gross foreign dividends received. And the following is a summary of how the following dividends and South African dividends, which was received by or has accrued to the taxpayer, are treated. The foreign dividends tax treatments. Foreign dividends are distributed by a company listed on the JSE Limited with a full exemption. Example, foreign dividends received with an amount of 5,000 rands, taxable income in terms of the calculations. What you're going to do is, let's say foreign dividends, that's part of your gross income. It's 5,000. The exemption will be 5,000. Remember, that's a limited amount. Taxable portion, it's nil towards the foreign dividends received from a foreign company in which an individual holds at least 10% of the total equity shares and the voting rights, which are fully exempted. The example would be the foreign dividends received amounted to 5,000. Taxable income calculations, 5,000. I think based on that one. The foreign dividends tax treatment, other foreign dividends, or the exempt portion of 25 divided by 35. Please be careful of that one. Write it somewhere where it's more where you can see it. Foreign dividends received to an amount of 5,000 rand, taxable income. So it's the gross. So you can all see that it's actually limited to an amount of 5,000 rand, or around the issue of the foreign dividends that is limited to 5,000 rand. So what you specifically do, you just say 5,000 rand, and you multiply by 25, you divide that by 5. I hope you've got that kind of an example. So it results into an amount of 2,778 in that example. If the question states that the taxable portion of the foreign dividends, that amount should be included in the final taxable income. Local dividends tax treatments in South Africa. Dividend received or accrued to a taxpayer's full example. South African dividends received amounted to 5,000 rand. Taxable portion calculations will be 5,000 rand, but then you less that adjustment. The question for you, as you can all see that, question A and question B. So as I said, I'm going to give you these questions. We'll do these questions together, and make sure that you do ask me questions wherever you don't want to understand. All right. And one more thing, guys, please, I'm asking you, when we meet in class, make sure that you do at least prepare so that you would be on the same page with me. But if you're not prepared, you're forever gonna be lost, and that will be a complete waste of your time. All right. Okay, let's see on what question A entails. Question A is, I put this from your guide anyway. Question A says that Mr. Giovanni is ordinarily resident in Italy and not ordinarily resident in South Africa. During a working holiday in 2017, he was in South Africa from the 1st of April 2016 to the 15th of February 2017. He enjoyed staying in South Africa so much that he returned and lived in Cape Town from the 1st of June 2017 to the 31st of December 2017. During 2019, in the year of assessment, he again visited Cape Town from the 1st of June 2018 to the 30th of September 2018. During the 2020 year of assessment, he returned to Cape Town, where he lived from the 1st of October 2019 to 31st December 2019. During the 2021 year of assessment, he was in Cape Town for 100 days. And he was in Joburg again from the 1st of September 2021 to the 31st of January 2022. The required part, I think I forgot to, okay, you need to indicate as to whether Mr. Giovanni is a resident of the Republic for the 2020 assessment based on the physical present test. This is what we have just done in the summary, in our theoretical summary, sorry.
Mr. Giovanni was in South Africa. He was in South Africa from 1st of April 2016 to 2017. So,
yes.
Yeah, the first year he did exceed 91 days.
Okay, no, let me just write it down.
And then,
okay.
Sorry?
Let me just, okay, you can carry on. Sorry, let me just write it down. Mr. Giovanni, he said, was in South Africa from
1 April 2016 to 15 February 2017. So he did exceed 91 days.
1st of April 2016, right?
Yeah.
To
15 February 2017.
February 2017. Thank you for that. Okay.
And then also from
91 days.
June, same year, June.
Right, just a moment. Sorry, just a moment for me. My apologies for that. It did exceed 91 days in terms of the pre-physical present test. Right.
Yeah, and then also from the same year, 2017, he also stayed in South Africa from 1st of June to 31 December, same year. So also
say from
1st of June 2017 to 2017 December.
Okay, to 2017, is it 31st December?
31st December 2017.
Okay. He did exceed it?
Sorry?
91 days.
Yeah,
he exceeded 91 days.
91 days.
Right, 91 days in terms of the physical present test. Right, you can carry on.
Okay, and then during 2019 year of assessment, it was in South Africa again from 1st of June 2018 to 30 September 2018.
Right, please come again, my dear. I think I've lost you there. In 2019
year of assessment, yeah.
Year of assessment. All right, he was in the country.
Yeah, from the 1st of June to 30 September.
June to the 30th of September.
30 September, yeah, 30th September.
Right, hold on. Is it the 1st of June?
Sir, can I say the question again? I cannot see the question.
Okay. Here's the question.
Yeah, it's the 1st of June.
It's actually the 1st of June. I can see that.
Yeah.
Right, just a moment for me. That's 1, 2, to the 30th of September 2019. He has, right? He has exceeded.
Yeah, he has exceeded, yes.
He has exceeded the 91 days. Right. Go on.
Yeah, so during 2020 year of assessment, he was again in South Africa from the 1st of October 2019 to the 31st December 2019.
Okay, let me just do this just a moment. All right, he was in SA from
The 1st of October.
1st October.
Yeah, to the 31st of December.
To 15.
31st.
Of December.
No, 31st of December, 31.
31st December. Has he exceeded that?
Yeah, he did exceed 91 days.
Has exceeded 90 Right. So which year of assessment again do we have?
Can I say the question again?
All right. Here's the question.
Yeah. Okay. During the 2021 year of assessment, he was in Cape Town for 100 days. So he exceeded the 91 days. He was in.
Okay. Right. From he was in the country from which date?
For 100 days.
He was in South Africa from which date? Sorry, from which date?
And let me see the question again. Sorry.
Okay, no problem. He said, I think it's the 1st of September.
Yeah, 1st of September 2021 to 31st January 2022.
Okay. First of September 2021 to December, right?
Yeah. 31st January, sorry. 31st January.
So we exceeded the 90 days as well.
Yeah.
In terms of Okay. So is that all?
Can I also see the question?
Okay. We'll give you the question. Here's the question. Can you see it?
Yeah.
Okay. Do you want to elaborate more?
Right now we have to find out if he was in South Africa for 915 days, I think.
Yeah, that's in 5 years, right?
Yeah, that's in 5 years, yes.
Okay. That's actually in 5 years. So you just have to calculate the number of days for each and every you add them together.
Yeah. Mm-hmm.
Okay. Thank you so much for that. That was highly regarded.
Thank you.
All right. Is there anyone who wants to add on? Sorry, who was I speaking with?
Blondie.
Okay, Blondie. Thank you so much, Blondie. Who want to add on what Blondie did, or want to minus or deduct on what Blondie was actually saying? Any consent? All right. Blondie, thank you so much for actually giving us that kind of an input, and that was actually really great. All right. When you approached up with this kind of a question, the first thing that has to come into your mind is what's called the physical present test, right? That should be the first thing that has to come into your mind. And the second thing, it's whether the person does meet or doesn't actually meet. Obviously, we are going to give you the date as to on which day up until which day was the person in there, right? So in terms of let me just have a solution in, because for me, I don't see anything wrong in here. You did exactly what I was. The only thing that you must just do in here is to write the number of days. If the person has been in here for, let's say, for example, April up until maybe the 15th of February, then you would say, okay, Mr. Giovanni has been in this country from this date, and the number of days that he has been in this country is for, let's say, 400 days. Let me just say 400 days. So in terms of the physical present test, yes, they do exceed the 91 days, right? Meaning that at that date, Giovanni was actually meeting the definition of a resident in the Republic. So that's actually on how easy it is. All right. So for that one, bear in mind that you will definitely have that kind of a question in your assessment. So the next assessment will have that. Maybe one or two, you might actually have that. Okay. So in terms of the year 20, we started on which year, Blondie? Is it 2016 or 17? Let me just see this quickly.
Yeah, we started on the 1st of April 2016 to 2017.
Okay, basically we had 2016 to 2017.
Yes.
2018 to 2019, 2020 to 2021, right?
Mm-hmm.
2021 to 2022. All right, thank you so much. All right, in terms of the 2016 to 2017 years, the person has been here for more than 91 days. And then in terms of 2018 to 2019, the same thing happened. 2020 to 2021, the same thing happened. And 2021 to 2022. So the same thing happened. So the only thing that you must just do is just to say, okay, in terms of the requirement, the person has been in the country for more than 91 days, but these are the exact dates that this person has been in here for. If they are like, let's say 92, you just write current year of assessment for that specific year of assessment, and then you say, let's say 200 days, and you'll say more than 91 days. You understand? And then you can further elaborate to say that the person was actually a resident in the country. But in this kind of a question, all the year of assessment they do meet the requirements. Right. Anybody who need clarity? Let me invite you. Who need clarity? Blondie sorted with this one. Anzani, you seem to have doubts. Lawhang, are you fine? Masbulele, actually, I want this person to speak. He or she has never spoken in this class. Masbulele, you can talk. All right. Because we don't have time, we'll move on to the next question. That means that we'll be done with our learning unit 3, and then we'll move on to learning unit 4. I hope we do have time. All right. Sipho, 22 years of age, married in community of property to Betty, and the following information relates to Sipho for the current year of assessment, with a salary of 150,000 rands, and then we've got a bonus, non-pensionable of 18,000 rands, and then we've got a local dividends of 1,900 rand, 26,000 rand. I think I'm missing the previous year. Local is 1.9, 26,000 received all the data received all the interest, 18,600 rand during the current year of assessment. Let me quickly look at that specific question. I think I'm missing something. Our salary is, Sipho salary is 150,000, sorry, and bonus is 18,000 in the local interest and the local dividends, 1,900 and 26,000 rand. And then pay to receive the local interest of 18,000 rand during the current year of assessment. Please calculate Sipho's gross income and exempt income for the current year of assessment. Anybody with an approach? So that's how deep tax gets. But it's actually one and the same thing. Okay, I'm just going to do this one for you. When you are approached about this kind of a question, this is what you do. You'd say gross income. Gross income. Let's see. The gross income. Then your second line item will be exempt income. Should there be any? Income. So the gross income, you're going to look at how much of the income did the taxpayer receive. Okay, so in this case, we've got a total gross income of, you just start by salary, then you go to the bonus, then you go to local interest and local dividends. Okay. Then you put all of these amounts together. So you see the salary is 150,000. The bonus is, let me quickly check the bonus. 18,000, sorry, 1,009. The bonus is 18,000 rands. Okay, and we bought local dividends of 1,900, and then we've got the local interest of 26,000 rands, 1,900 dividends, and 26,000 rand off. Okay, let's see. But 1,900. Remember, Sipho is actually married in community of property, so they have to go half, right? And then the local interest as well will be 26,000 rand, and then you multiply this by 50%. Then you go half. Okay. So the wife The wife also include the interest with an amount of 18,600 rand, just to make things fair. It will be shared equally amongst themselves. So you just say local dividends or local interest. That would include the wife. 18,600, you multiply this by 50%, or you can just divide that by 2, because that will amount to half. So how much is 26,000 multiplied by 50%? Is it 18,000? 26 divided by 2, 26 divided by 2, 18 is 36. Somebody help me quickly. It's 13,000, right? Then the wife, 18,000 divided 18,600 divided by 2, it should be 9,300. Let me just verify that on the calculator. 18,600 divided by 2, sorry, divided by 2, yeah, it's 9,300 rand. But the local dividends is what I think is about 900 or 800, 950, 1.9 divided by 2, it's 950. Are you all happy? All right, and then we're going to add them together. What? So the total incomes would be 150,000 plus 18,000 plus 13,000 plus 9,300 plus 950. So total income will be 191,250. 191, 191, sorry, 191,250. And you're going to have what's called the exempt. Let me just put it here. Right, we all know that our dividends as well as the interest are actually exempted, but they've got certain limitations. But we're now dealing with the local ones. So in terms of the dividends, the full amount is going to be exempted with an amount of 950. And in the interest exemption, we're going to look at the limitation. It's 23,800 rand of the actual. How much is the interest? The interest would be 13,000 plus 9,300 rands. So this is how you're going to account for it. Dividends, interest. Okay, so interest would be limited to an amount of, we are considering the 8 factor there, 23,800 rand. 23,800 rand. So this is what we are going to do. What we do here is we'll say the interest for both, and then we add them together. Let's say 9,300 plus 13,000 rands, and then it's 22,300 rand. Then this is what you're going to do. Let's say 22,300 rand. Remember, it's 23,800 rand, right? But it means it's actually less than the limitation. 23,800. So individually or both of them combined, they pay 22,300 rand. So it's going to be fully exempted, and the dividends, it will be exempted with an amount of 950. All right, then we're taking the exemption, we're taking the incomes, and then we are going to minus them from the exemption. So it's 950 plus 22,300 rand, and then it's going to be minus from 191,250, meaning that we are going to have the taxable income of, or the income. Let's say taxable income to total to an amount of 168, 123, and then you close it off. Okay, so that brings us to the end of our question 2. We need clarity here. Is everybody happy? Is everybody happy? All right. When you go to learning unit 3, I think there are some multiple choice questions where you can just try to attempt them. And I think they would lead you somewhere. Make sure that you do all of those questions in there. Whenever you've got a concern, make sure that you let me know, and then I'll be able to assist you. It depends on where will I be at that time. Everybody happy? Can we move on to learning unit 3? All right, I'm giving you a 5 minutes break. Come back at 21 past 10. We're gonna have somewhere around like 39 minutes to end our session for today. 5 minutes break. Get that water or tea or whatever that you want to do, a stretch, and then we'll be back at 21 past. Thank you. Without any waste of time there, so it's learning unit 4. That's a general deduction formula. So the background goes that the deductions are deducted from the gross income, and the Act allows certain deductions against the income from the taxpayer, and these deductions can be specific. For example, your retirement contributions and donations, and they may be of a general nature. So let's have a look at our definition here. General deduction formula in terms of the Section 11 of the Income Tax Act, it goes as follows. For the purpose of determining the taxable income derived from any person carrying from trade or any trade, they shall be allowed as a deductions from the income of such person so derived. Okay, this is more like when you are trading for a business, they're obviously going to have incomes, and then you're going to have what's called the deductions. There are those that are allowed as a deductions, and there are those that are actually not allowed as a deductions. They're called prohibited deductions. So the expenditure and the losses actually incurred in the production of income, provided such expenditure and losses are not of a capital nature. So just familiarize yourself with the concept of capital nature there. So it says any money is claimed as a deductions from the income derived from trade to an extent to which such money were not laid out or expended for the purpose of trade. So these are your examples or the requirements in terms of some of the deductions, or what the deductions, general deductions formula says. You must be carrying on a trade, and there must be an expenditure and losses that are actually incurred in the production of income and not of a capital nature. They should be partially or fully expended for the purpose of trade. So meaning that if they are partially, whatever that is partially for is going to be deducted, but if they are fully, that means they are going to be fully deducted. What? Just know that all of the requirements must be present for an account to be deducted or for an amount to be deducted. Should you miss one there, it means that it doesn't meet the general deduction formula requirements. Okay, and then moving forward to further referral, you will not need to apply these requirements for the general deduction formula every time you wish to deduct an amount. Alternatively, what you can do is, where you are confronted with an expenses that you are unsure about, you will need to apply the components of the general deductions formula to ascertain whether it meets all the requirements and is consequently deductible or not. It is important to realize that part of the general deduction formula has to be complied with in order for an example to be for an expense to be deducted. Sometimes they bring you this kind of an expense that you're not sure as to whether it has to be deducted or not. But if you know, you know. So you just have to stick to the requirements in terms of your general deductions formula as to whether it's going to be deducted or what. So you will see as to whether it does meet all of those requirements, whether they are for the trade, they are actually for the expenses or the expenditure or the losses, not of a capital nature, or partially or fully expended, are they in the production of income. All right, let's look at each requirement separately. So the carrying on a trade is one of the requirements which include every profession, trade, business, employment, calling, occupation, or venture, including the letting of any property. It is clear from the definition on that one. So it should actually go along with the definition of the requirements of a trade. It has a very wide meaning and it includes any salary, it includes the rentals, it excludes the interest in the dividends, and it covers the general trade related expenses and some of the specific expenses. In order for any expenses to be deductible, and the taxpayer must be carrying on the trade. So trade is actually the core item there. Once you realize that there's a trade in there, I don't think it's going to trigger you in terms of identity or identifying it as to whether it's relevant to that one. It is also important to be aware that the definition of a trade is a very wide, extending beyond the running of the business, which include activities such as carrying on a profession, as well as being employed. It is also important to note that passive investment activities are not included in the definition of trade. Well, that means what where the expenses are incurred any investment income, they will not be deductible according to the general deduction formula. In terms of the passive investment that generates the returns such as the interest and the dividends. So basically, the dividends and the interest that you receive as a return, it's a passive investment. What and if the taxpayer is actually not carrying on a trade, he or she will be allowed to deduct the general expenses from the income received. And if the person speculates in shares and carrying on a trade, but a person who incurs expenses related to his or her hobby. So the stumbling collecting is part of the example there, which is actually not carried on a trade. All right, you'll stop me there if you don't, if you actually not clear with something. But for now, let's just summarize the requirements for the general deduction formula. For the expenses of a general nature to be deductible for income tax purposes by a person earning a salary, there must be a trade as well. And also so that any of the salary is defined as a trade for income tax purposes, that would be for individuals who are employed. I will now follow briefly consideration each of the other requirements for the expense to be deducted as that. Let's have a look at expenditure and losses. But before we go there, you need to always remember that if the taxpayer has an expense, it must comply with all of those requirements. There is no significant difference between the two concepts. An expense is paying in return for the goods or services. Okay, so whether you like it or not, when you've got a business that generates an income, there are going to be an expenses that you have to incur, or the losses. Right, and a loss is an expense of an involuntary nature. For example, stocks that has been burned in a fire. That's a nature. Sometimes you don't have control beyond that. When working through the sections, note that deductible expenditure is not restricted to expenditure in cash, but include any outlay of the amounts in a form other than cash. Therefore, if a shopkeeper offers an asset instead of cash as payment for the new stock, then the market value of an asset will always be deductible. So remember, and I have spoken about this, so when you are receiving an income in a form of an asset, there should be a market value attached to that kind of an asset. So this is exactly what they are explaining here. So where a taxpayer is acquired an asset through inheritance or donation, and the subsequent use is to pay something, then the market value of that asset will be allowed as a deduction. Okay. They will tell you how much the market value is. Actually, in CAT, a taxpayer may deduct expenses that have actually been paid, as well as the amounts that have been owed. The liability for the expense must be unconditional, which means that it must not depend on some future events that would happen or accrue. So when an event must take place before an expense becomes payable, the expense will only be deductible for the tax purpose for that year in which the event actually took place. Right. In terms of the production of income, the expense must be for the purpose of producing an income. Let's say, for example, you're renting an apartment somewhere to run your own motor spare shop. So basically what is going to happen is you have to pay the rental so that you will be able to earn an income for the sale of those inventory of goods. Okay, so obviously there are people that you're going to pay them a salary. Maybe there's an insurance should anything occur. Maybe the building can get banned, or stock can be stolen, or it can be damaged. So insurance will be based on that one as well. So not of a capital nature. Capital nature is not deductible in terms of the general deduction formula. This means that the expense cannot be expended to contribute to the taxpayer's income producing structure. The expense must be in terms of running of the trade, not of a capital nature, as I've explained. And for the purpose of trade, all the above requirements must be met for an amount to be deductible. If anything is actually missing, it means that it doesn't qualify to be part of your general deduction formula. Okay, let's have a look at your prohibited deductions. You remember when I told you about the deductions that are not allowed to be deducted, right? Items that are actually not allowed to be deducted. The Act specifically provides a list of Section 23, the amounts that cannot be deducted or prohibited deductions from the income. In this course, you do not have to know the complete list of the prohibited deductions. You do have to know the following deductions are actually prohibited. So it's either way, you know those that are listed or you comply with the general requirements of the deduction formula or the requirements in terms of the general deduction formula. Fines, for example, number one is domestic and private expenses, for example, groceries, cell phones, cell phone expenses, etc. And then you would have fines, for example, traffic fines, or the expenses relating to employment, legal expenses relating to the salaries employment issue, or an employee may deduct any legal cost incurred that is directly related to their salaries, for example, your CCMA proceedings. So when you pay that lawyer for your court in terms of failing to understand or failing of an employer to comply with some sort of a disparities, then obviously that would not be deducted as part of your expenditure in terms of carrying on a trade. The wear and tear of an asset that is used regularly for the job. This is calculated using the cost of an asset and dividing it by the useful life of an asset. I think we're going to have a little bit of those kind of transactions or examples when we do Learning Unit 6, if I'm not mistaken. So home offices expenses, if the job requires a taxpayer to have home offices, I think it was discussed somewhere in some radio talk about people being working at home due to this pandemic, how do they claim their expenses and all of those. So home offices expenses, if the job requires the taxpayer to have some home office, or the cost relating to the home office may be deducted from the taxpayer's taxable income. So remember, when you're using your office, it's now going to be your room, or it's more like, or treated to be like your operations of work or your operations of your business. So the design in regards to that, I think that will actually be your own responsibilities. So these will include the costs such as the rent, repairs, and the maintenance and other applicable expenses incurred with regards to the home offices. Retirement fund contributions, we're going to deal with that in Learning Unit 6. So, but it's important to also remember the order of deductions. Donation to the PBO, Public Benefit Organization, the last time I checked, it was actually 10% of their taxable income. All right, it looks like we are actually coming to the end of our session with 2 questions. Right, we're going to deal with question A and then we do question B. It has part A and part B. And as soon as we are done with that, I'll be open up for questions and I hope we'll have more time. And then we will close up and then we'll meet some other time. Before I go to the questions, let me bring you all up to speed. Any questions? We've got CNA or Nompa here. Welcome. Any questions? Actually, I find this learning unit much more easier as opposed to the previous learning unit. Learning unit 3, it's a bit tricky. Not that it's quite difficult, but it's just a bit tricky. But this one is just short and concise. It's very easy to understand. Okay, cool. It seems like people don't have the questions. So we'll just go to question A, which says, Mike Baker owns a bakery in a coffee shop. A customer lost a finger when he used the bread slicing machine that is available to customers who purchase the bread at the bakery. Mike was liable for the compensation that was paid to the customer. He would like to claim the compensation as a tax deduction. The required says, Mike, please discuss whether Mike will be able to claim the expenses in terms of the general deductions formula. Anybody quickly? Who's got an idea, the approach? It's important to know how to approach the question when you're faced with it. Anyone quickly? Blondie, do you want to attempt this one as well?
No, to be honest, I haven't, I'm still busy with this chapter, so I don't have a clue now to do the calculation. Yeah.
That's fair enough. That's fair enough. All right, everybody, I just want you to listen effectively when it comes to this. When you are faced up with this kind of a question, all you have to do is you first have to list the requirement in terms of the general deduction formula. You remember when you define that because you earn marks for that. So you must just tell me the requirements, which are your trade, they must be or constitute an expense or a loss, or they must be actually incurred in the production of income, and it must not be of a capital nature. It must be expended partially or fully for the purpose of trade. So that's your first step. You give me the requirements. The second requirement, or the second part will be you're going to analyze it based on the scenario that you are given. Right? We all know that Mike owns the coffee shop, and I think owns the business of a coffee shop. And one of the client came in there probably to buy, and then the client cut himself on a finger when he was trying to cut the bread. You're still within the premises of the expense, and then who is actually responsible for that? So we're told that Mike is actually going to be responsible in paying all of those damages. Right, we're going to establish who Mike is and his business in terms of the above requirements. Was Mike carrying on a trade? And the answer would be yes. Mike carries on a trade as he owns a bakery and a coffee shop. Compensation was paid, and therefore there was an expense. Compensation was paid because Mike was liable to pay the client. Was the compensation paid, or was it actually incurred? The compensation was actually covered on both. It was paid, and therefore it was actually incurred. And how was the expenses? Closely in terms of the connection. So the expense needs to be closely connected to the activities that produce an income. Is a baker, obviously the intention is to produce an income. It is a yes. So the compensation for the injury is not closely connected to the income production by the selling of the bread. I'm surprised, why do they say that? Okay, because the activity was just to cut the bread into slice there, but it was actually not closely connected in the income production by the selling of the bread. All right, does the expense not create an income producing structure or not enduring the benefit in terms of creation? The expense was fully incurred for trade. So the compensation is actually not deductible as it does not comply with all of the requirements of the general deduction formula. Remember, I told you that should you miss one of the requirements, then that means you do not have to actually support the issue of the general deduction formula in terms of the definition. So that's how That's how you're going to summarize the scenario in terms of the general deductions formula. And then you're going to give your facts, or you're going to give your analysis in terms of your opinions as to how you're going to go about that kind of a question. Right? Let's see. Anybody with a question? It's not bad, right? It's definitely not bad. Masbulele, you still owe me to a greeting in the class. Okay, Masbulele doesn't actually want to speak. All right, so when you've got your own spare time, you will realize that this is actually not a difficult content or learning unit. It should be easier because a lot of calculations are going to be there from learning unit 5 up until learning unit 7. So we are almost done. I think we've covered more than 50% of the work so far. And then we are only left with 3 learning units, and we will cover that as and when we meet again. I'll give you the details at the end of the class as to when are we meeting for the class again, and then what are we doing in the next class. Okay, part 2. Question B, part A, it says, during the year of assessment, Mavis Tau, a South African resident, lost her job. As a result, she decided to sell her car. She bought the car in 2013 and sold it for 80,000 Rand cash during the year of assessment. So if we were doing accounting, we were going to be asked to calculate whether the disposal was on profit or was actually at a loss. So the required says that list the requirements in terms of the definition of a gross income in terms of section 1 of the Income Act, and apply the information provided to determine whether Mavis should include the 80,000 Rand in the gross income. All right, the same principle would apply, guys, if you are faced up with a gross income definition, not the calculations per se. So obviously you need to give me the definition. Is the same would apply to the general deduction formula. Do not confuse that with the physical present test in terms of those number of days. All right, let's have a look at what the gross definition entailed. It says that in the case of a resident, Mavis is actually a South African resident. That's true. He's actually in the country. So the total amount in cash or otherwise, Mavis received an amount of 80,000 Rand in cash. Was it received or accrued to? Yes, the money was actually received by Mavis because the car was actually sold. And was it during the year of assessment? The money was received during the year of assessment. Exclude the receipts and accruals of a capital nature. The car was actually in a capital nature. It was an investment and not keeping it for speculative business purposes. The amount cannot be included in the gross income because it is of a capital nature. Remember, that was not a salary. It was a sale of the own private car, right? So it's important to know that definition of the gross income. It's easy. Three things that you must just know in that learning unit. Gross income definition, forget about the calculations for now. General deductions formula, the physical present test. Those are the 3 major things that you need in learning unit 3 and learning unit 4. Am I making sense? Okay, so the final question. John Blanc was employed by South African Police Service SAPS for the full year during the year of assessment. John Blanc paid 6,000 Rand for his DSTV subscription for personal use. Right, list the requirements of the general deduction formula and apply the information provided to determine if John will be allowed to deduct the DSTV subscription for the current year of assessment. For my personal view here, this is actually, I'm not sure how the solution would look like, but I think it's a, what do you call this thing, prohibited deductions, right? Because it's actually not for any income, it's just for personal use. Okay, so was Mark trading, carrying on a trade? So you bring me the definition first. The expenditure was not incurred for the purpose of trade, but for personal use. They specifically said that it's for DSTV, which is actually for personal use. So was it an expenditure a lot? Paying the DSTV subscription is actually an expenditure. Was it actually incurred? The amount paid, therefore, was incurred. He paid that specific amount. Was it in the production of income? That's 5 for the personal use, and not in the production of an income. It's a no. Was it during the year of assessment? He paid the amount during the year of assessment, but it's not relevant because it falls under the personal capacity. Not of a capital nature. Paying is like buying an asset, therefore it is actually not of a capital nature. But the conclusion, which is important, you will just say it's a no. It doesn't meet the general deduction formula discussion. The general deduction formula. All right, so this amount will not be included as a deduction for the year of assessment because in terms of the definition of the general deduction formula, it does not meet all of the requirements. Right, that brings us to the end of our session for today. Is there anything that you guys need a clarity on before I say goodbye? Okay, it sounds like you need more of studies to understand it more. All right. Please don't hang up. I just want to speak something with Catherine. Catherine, may I have you, please? Catherine? It seems like Catherine is not here.
Yes, what is it? Yes.
Oh, no problem. Yeah, I had Makoto saying that you're going to be on a break for some time. So I would like to know as to when can we resume the class. I think it's about 2 or 3 weeks.
When is the due date of the assignments?
All right, let me just, Blondie, can you just confirm the due date of the next assignment? I'm not sure which date is it. Blondie?
I'm also not sure which date it is.
Okay, tell me, is this module, Mr. Meso, is it the exam? Is the exam date or is it just continuous assessment?
It's only continuous assessment. They don't write an exam.
Okay, so when is the last assignment due?
What, when is the last assignment due? Who has the details of the assignment due date? Please, somebody help me quickly. All right.
Let me check.
Okay, please check.
That's a black pencil.
But Catherine, while she's still checking, when are you back?
There's a black pencil.
Remember, we have a class next week also, right?
Oh, I thought you were going to be on leave from Monday.
No, we have a class. You are scheduled for this week, next week also, don't you know?
I have to check my email. No, that's fine then. We can discuss that next week. I thought it's this week.
No, let's discuss it next week, eh?
All right, no problem, guys. Next week when we meet, please make sure that you bring me the dates for the assignment so that we can plan the next meeting. All right. Otherwise, I thank you very much, and I hope you guys have a lovely week. You go rest and be at peace. From me, thank you so much and goodbye.